presentation contains current opinions of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello, everyone, and welcome to the Compact Market Wrap Update for June 22nd, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President here at Compact. Thank you for joining us today. First of all, a housekeeping reminder, click and like thecompact.com. Just click on the subscribe button, and whenever we post an update, you'll be notified and you can watch it at your convenience. Also, if you need help with your portfolio, send us an email at compact.com or invest@compact.com, or just give us a call the old-fashioned way, 800-388-9700. Another note, the book is coming up. Javaid, do you want to talk about the book?
Yeah, really excited about the book. Been talking to clients about it over the last couple of months. It'll be coming out here in the middle of July, so you still have time to pre-order it. Feroz is also working on the audiobook as we speak. But once again, really a testament to what we really preach here at Compact, which is to really look at things holistically. Not only wealth, but how are we applying this wealth to hopefully enhance your life experience over your lifetime? And so the book kind of codifies a lot of that in the pages, and we have some cool assessments and everything. So just go to wisdomandwealthsolution.com. You can pre-order the book. You can also take some assessments, understand where you sit on your Live 360 grid and compass, which are two main components of the book. And these are things I talk about with clients, both prospective and new clients, right in the beginning, because it really helps me understand what is their orientation, the why of why are we growing this wealth, and how can we hopefully steward it in a way that allows us to give us the maximum benefit. So go check out the book, Wisdom and Wealth, and we'll have more on that. Maybe even do a YouTube and podcast right just on the book as it gets closer.
Yeah, I think we'll have Feroz on. He, as you know, has worked with me for nearly 25 years, 24 years. He's worked with us here at Compact. He's also an adjunct professor at UCI, University of California, Irvine, teaches the MBA class there. And just for fun, that's just his fun thing that he does, besides working with us. And he we'll have him on the podcast.
I think in the next couple weeks,
the next few weeks, and then he'll talk about the book, how it really, what I've done, if you've heard me for the last 40 years nearly now, on the radio broadcast and on Compact, all the podcasts and all the seminars and all of that I've done, I think he's sort of puts it all together. Why do we do all of this? Why do we work so hard to create wealth, financial security, and how to make sure we pass it along, be good stewards of what we have created over our lifetimes? And that's really what it sort of summarizes, all of that. And it breaks down a lot of the notions that we have, that sometimes you get so caught up in all the stuff that really doesn't matter and what is really important. That's really what the book is all about. So go to wisdomandwealth.com, wisdomandwealthsolutions.com, and you can pre-order the book. It comes out in the middle of next month, only a few weeks from now. It's on Amazon, and you can pre-order it right now. Let's start with the numbers, Javaid. A good week last week in the markets.
Well, we got a deal, right?
Yeah.
So S&P up 1.47%, Dow up 1.45%, Russell, which has been good all year, up 2.05%, up 20% year to date. I want to talk a little bit about the Russell and mid-cap, because I'm seeing some constructive things there.
Finally, you're coming around.
Finally starting to come around, just because I like where the earnings momentum is going, and I like the broadening out. So we'll kind of talk about that going forward. And then we'll look into EFA was up 3.5%. Emerging markets up 7.6% last week, the big winner, and NASDAQ up 2.76%. So I think as a lot of the uncertainty around the Middle East has dissipated,
right,
that's having a lot better effect on particularly Asian and European countries, because they were going to be the most affected by the closure of the Strait of Hormuz. Now that looks like it's kind of being curtailed, we'll see. We're in this 60-day period, but we'll talk about one of the key charts we've been monitoring, DBO, which is monitoring the oil futures that broke below a key support level last week. So that just was kind of the big indicator that maybe we're getting this episode behind us. Now, I think it's anyone's, there's a lot of opinions out there of how it's being resolved, whether we got what we wanted and all of that. I think that's for the political realm to a certain degree, and we'll see what the long-term implications are. But in terms of equity markets, inflation, oil prices coming down is very positive.
Definitely a positive there. And that was what was reflected, 7.62% for the week in emerging markets. I think they're going to be the biggest beneficiaries if they do get everything resolved, as long as the oil is flowing out of the Straits of Hormuz. That's really what the Asian markets and the emerging markets are concerned about. That's really the biggest thing. And it seems like the Straits of Hormuz is open. NASDAQ also had a good week, up 2.76%.
Well, and I think those two are tied. I think emerging markets, you're getting the benefit not only from, that those Asian countries are very tied to the Strait of Hormuz, so they're getting that benefit if that's going to get resolved. But also, if you look at the emerging market index, it's very much tied to AI. And it's Samsung, it's TSM, Taiwan Semiconductor. So it kind of has a little bit of both. It kind of had that super, almost SpaceX type of movement last week in a rather index. I don't think SpaceX is doing great today. But we can talk a little bit about SpaceX. It happened while we were taking a little break. But overall, I think emerging markets, you got to be a little careful. It's giving you that diversification, but it's also it's very much along the tech.
The biggest two stocks in emerging markets are Samsung and Taiwan Semiconductor. So is this a chip stock company index, or is it an emerging market index? That's really the question that you need to ask yourself. But it was a big move to the upside in technology. And this was a nice surprise here. This was not really a surprise, but a nice move here for industrials.
Yeah, and financials. Financials are up 1.8. They've been kind of lagging all year. They're still down this year, but I like to see financials popping a little bit as well.
Energy was the biggest loser last week. Obviously, with oil prices coming down, but still at 20% for the year. Oil down to $76, and that's down from 120, which was the peak during the Iranian crisis. And now we're back down to 76. And I think it's going to, as I said, around 75 to 80. It's expensive. It's higher a little bit from where we were on February 28th, but I think it's manageable here at 76.
Yeah, and I think if we still have the growth, which is what we're seeing in the economy, then we can really maintain these higher levels of oil. I think we're going to settle into a higher range, but hopefully we've taken off that catastrophic kind of huge oil spike, super inflation. All of that seems to have not come to fruition because we're looking to cut a deal. But I do feel like I think people are now going to be a little bit more skeptical around using the Strait of Hormuz. It's going to be more expensive to use the Strait of Hormuz in terms of insurance and all of these other things. And so there's going to be some more workarounds, pipelines developed through the Middle East and all of these things over the next couple of years, because people realize, wow, it didn't take a lot to shut down 20% of the oil capacity of the planet, overnight with the Iranian situation. So I think we'll probably settle into some slightly higher levels. That's why I think the 10-year, the 10-year is really important from an inflationary indicator perspective. It's kind of really settled in, still above, tangibly, we're not in the 3 handle. That means 3 point whatever, we're still in 4% or higher. I think we kind of don't quite see interest rates go down a lot.
The question is, are they going to go up? That's the big question a lot of people are asking now.
Yeah.
But because they said there's going to be this inflation spike. I think inflation is going to be transitory. I know, that's the word that was used.
I can't believe you're using that word. We're not allowed to use that word.
I know, Powell used it in 2020 and said it's transitory. It wasn't. We want inflation to go to 9%. But I think the spike that we saw in oil prices, if oil prices stay where they are now, I believe inflation is also going to drift lower. It's not going to come down straight down, but it's going to drift lower over the next 6 to 9 months, provided oil prices stay around $75 a barrel.
No, I agree. I think one of the biggest components of inflation. In fact, we're going to get the PCED. So this is one of the core kind of inflation numbers that the Fed watches. So we're going to get that this Thursday, actually, and it's expected to be around. CPI was up 4.2. This thing could be up 3, almost 4%. So it could even surprise on the upside, and that's why now we've seen a little bit of on the short end of the Treasury curve, maybe some expectations of a Fed hike in July, just to curtail a little bit of that inflationary. But I think that's about it. think we get 25 basis points. We did, I mean, it's a good segue into Kevin Warsh's, the new chairman, press conference last week. And he was pretty kind of, he's kind of pulling back on the communications. But I think the one thing that the market really took from it was that, he really reiterated the 2% target. We've talked about moving the goalpost right here on the podcast about the Fed being okay with 2.5, 3%. But he was really kind of adamant that says, hey, 2% is our 2% goal. And we'll see whether that's just talk or if there's a lot of action.
But he did
behind
also mention that they're going to set up a task force that is going to study inflation, a lot of these different things that the Fed does. And they said they're going to look at the components that go into calculating inflation. If they change those components, that could bring inflation down, or the numbers.
Yeah, but the market, that's all just kind of engineering, right? It's just kind of changing. The market still understands whether it's an inflationary environment or a deflationary environment, depending on whatever you're calling it, right? So the market's going to look through that. So we'll see. I think a rate hike. I'm not quite in that camp that we see a rate hike even later this year, particularly if oil prices come down, rather precipitously over the next month or two. So we'll see, but time will tell. But I don't think we're in a rush. I think interest rates are in a good place, not too high, not too low. And so the market can continue. We focus on the main thing, which is really earnings, as we continue to progress through the year.
Yeah, and they're talking about the 10-year interest rate. That is 4 point. It's just steady. It's not going up. It's not going down. Yes, it's elevated from the low 4% rate to maybe 4.5 now. But I think I don't see any interest rate increases or decreases. That's the way I'm looking at it right now, depending on where inflation and oil prices go, depending on where oil price, even though if we get inflation numbers a little bit higher than where they are right now, I think we'll still be okay. That's my feeling, that they're not going to raise interest rates. They're going to take a wait and see attitude and say we're okay with where we are now, and we go from there.
And just talking about what is the potential future on interest rates, I look at my MOVE index, right, which kind of looks at volatility on the market on interest rates, and it's basically been stuck at 70 now, going all the way back to middle of April. I mean, so even kind of at the height of when a lot of these situations were happening, the bond market remained pretty calm. Said, this isn't good. We don't like what's going on, but most likely there might be some sort of capitulation, maybe on one side or another, going to be some sort of deal at some point. And, and so if interest rates still maintain anything below 100 on the MOVE index is a very kind of stable environment when it comes to interest rates.
These are momentum stocks.
Yep. So listen, for all of our podcast listeners, once again, we have a YouTube version of this podcast. So you can just go to compact.com/YouTube. You can see the weekly charts and, of course, our technical charts, which are, of course, best in full color. But you can see this weekly chart where we're talking about momentum versus quality.
And momentum stocks are still up 35% for the year, while quality stocks are only up 10%. But we saw industrials catch up this week. So I think we are seeing a little bit of this broadening out of the market.
Well, exactly. And that's what we saw, I think, with small cap, mid cap. We're seeing some of the earnings expectations not only have been very robust, right? The future PEs, the forward PEs are very, they've come down, is because everyone's expecting more earnings. But we've also seen that for mid cap and small cap stocks. And now we're seeing international and emerging market stocks. So we're seeing a nice broadening out across a lot of different market capitalizations as well as international. And I think that's all very positive. That said, let me just caveat this.
Okay.
I think if we go higher from here, I still feel like we'll see if this broadening out. I hope it continues to broaden out.
Right.
And so then that's going to mean that we can actually have very sustainable gains. Where we're at right now is not necessarily a market top. We can continue to go higher and higher. If we see a lot of this momentum stuff, I think, continue to lead to the upside, I think we're in some of these latter innings. So we really need these earnings to come to fruition, this market to really broaden out. It's not all about AI, but AI is going to be translating hopefully into other industries, et cetera. And so then the earnings momentum is really translated. I
need to see an ROI on all of this AI spending. That's what return on investment, as it's called. They're spending hundreds of billions of dollars on AI. Is it going to pay off? What companies are going to benefit from it the most? That's the thing. Right now, it's just building data centers, and
Yeah.
anything that goes into data centers is going up. But there'll be data centers that are built. Now what? We spent all this money building the data center. Now what do we get out of this data? Do we get any revenue out of that? And that's the thing that I'm looking at and thinking about. Where do they make money? Just like the internet.
Well, I'm glad you brought that up because I've been looking into more of this. There is actually, everyone was talking about SpaceX. This is not last Friday, the Friday before. But there was something else that happened that day. Not a lot of people were talking about it, but Anthropic, right? We all know Anthropic, potentially Anthropic, they have Claude is their AI. And then you have OpenAI, right, with their ChatGPT, which everyone knows. But Anthropic on that Friday, they actually stopped the allowance of Mythos and another one of their AI models because the government said there was national security risks here. And they immediately pulled it. So if you're a company using that AI model, suddenly you're not able to use it overnight.
Right.
And so where are these companies starting to dabble? Well, they're saying, well, maybe we don't want to quite be in these closed AI infrastructures of OpenAI and Claude because these guys at any time, number one, we're paying a boatload to token and use these AI, and they can take it away at any time. So what have they started doing? They started to use Chinese AI. And China has a lot of, actually it's kind of, has actually more open AI than OpenAI does. In that they have, it's called open architecture. And I think China's play on AI, and this is a big concept, because I think this is something to really monitor going forward, is looking at Chinese AI versus American AI. You know, American AI, you basically have these big companies, they're developing it, they want to monetize it for a profit. I think China's going to go about it in a different way, where they're going to develop AI, but they're not in it for a profit. We're talking, this is the Communist Party here, right? Developing this and fueling all of this investment. They want the information, and they're going to give it away for free. And so then companies are going to say, and this is very, it kind of reminds me a little bit of globalization, right? When, you know, Chinese labor came, it was much cheaper, so countries go, hey, I can make stuff here in Michigan, or I can make stuff in China for 1/10 of the price. I'm going to go make it in China and ship it across the Pacific and make a boatload of money. Well, I think AI is going to be very similar. AI is different in that, you know, it potentially can be regulated and controlled, maybe easier or not. It's not that physical commodity, but I think that government regulation around AI is going to play a huge role. And I talked about, you know, eventually I think if it starts to cannibalize jobs, it's going to kill AI. But I think also how companies are allowed to interact with Chinese AI versus US AI and all of those different dynamics are going to start playing out. But my one issue, and this goes back to your profitability about AI, is that the Chinese version of AI is free. And if your competitor is giving the same type of product
For free.
why
would you pay for it?
Why would you pay for it? And so that's just something that, unless the US says, hey, you can't use it, right? Or you're prohibited from using it.
We ban it here.
But then, you know, makes us more insular. And so people in India will say, well, we're not banned from it. We're going to go use the Chinese AI. We're okay with it. People in Russia, people in Europe or in Africa, whatever, because it's free and they get the benefit of the AI and they don't have to pay the cost. So it's just something, I'm always I'm comfortable with where the market is today, but I'm always trying to look for those things that could really kind of circumvent what is the narrative that's promoting the market today. And that's the AI investment.
It's like the internet. You know, Facebook came along, it was free. You could just go on Facebook and you could get all these connections with all of these people.
I think it's still free.
And it's still free.
Yeah.
But why did Meta or Facebook as it was called then, give it away? Because they were getting all the data. They were getting all the information on everybody, what they were thinking, what they were doing, and they could monetize it later.
Through ads, yeah.
And that's what the Chinese are using as that model for their AI, compared to the US is saying, look, you can use our AI, but you got to pay for it.
Every time you use it.
Every time you use it. So it's going to be interesting to see how this works out. And that's a really interesting way to look at it.
Because it's a global type of situation. And I think data is becoming the new kind of thing that we're fighting over. Yeah, because you could, now particularly in this political environment, if you have dirty data, if you will, on politicians, you're going to use that to your advantage. So all of these type of things are becoming, the data is becoming much more ubiquitous. And the more you can get that data, the more powerful you are.
But that's why I think when OpenAI and ChatGPT and all of these companies were developing AI, I said, look, the ones that have the data are the ones that are going to really be able to monetize AI using their data. And which is the company in the world that has the most data? Google. They've got everything we search, everything, and they have it for the last 30 years.
Yeah.
They don't have data from 1 year ago. They've got the last 30 years of data since the internet came around. So I think data and Meta and companies like that, but how do they monetize that data and how do they use it in AI to monetize it? That's going to be the interesting part.
Google took a pretty big hit today. It was down 5%, which is a pretty big move on Google. I think some of their key executives, I'll have to look into it, but
They left today.
They left.
Yeah, they left. They went and joined Anthropic.
They've joined Anthropic.
Yeah, their head developer of AI left today.
And I think that's going to be really interesting to see once, I think, Anthropic and OpenAI, they have to go public at this point to continue to maintain this spending. And then we're really going to see, we've always had these proxies for AI, right? Google, Microsoft, Amazon, Apple, which is the device, NVIDIA, which is the chips, and Taiwan Semiconductor, which is the chips, and then you have Micron, which is the memory chips, right? These are all real businesses, and they have a lot of applications, but it all feeds into the AI infrastructure. And then SpaceX, they actually build rockets, right? And Starlink, it's not just Gronk and AI there. But I think when Anthropic and OpenAI IPO, now we're going to have the first two really market proxies for how much of the monetization model investors are willing to pay. And I think that's going to be really seminal to watch here really closely to see how much appetite the market actually is going to really facilitate in terms of these are the companies, their only marketable security is the AI, right? And to monetize it, how does that compete against the Chinese AI? How does that compete against Gemini's AI? All these other things. I think that's going to be a very, very seminal moment for the market here. And we'll probably find that out. We'll have those indicators in the next couple of months.
That's pure AI play instead of stuff that's feeding into AI, like NVIDIA and Micron and all of that. So we'll see how the market values that and sees how much money they're going to make. And then they're going to come up with a valuation.
Correct.
So we'll see how this plays out. FOMC meeting last week was interesting. Warsh was his first as chairman of the Federal Reserve. He came out, did the press conference, which was an interesting, very different press conference than Jay Powell. There was a lot of different stuff. I watched the whole thing. And I think there are changes coming at the Federal Reserve. How they're going to implement that, how they're going to change stuff, what are the goalposts that they're going to set, it's all up in the air. So we'll see how that settles out. Retail sales were still up. People are still spending money.
I think it's one of the best things that we can continue to watch here in terms of, everyone talks about, consumer confidence is down, all these other things. Well, if consumer confidence is down, why are people going out and still spending money like it's going hand over fist? And this even takes out, if you look at it, it was up 0.9, but a lot of that was a big surge and people are paying more at the pump, right, for gases and everything else. But even if you take that out, it still rose at a solid 0.5% if you take out autos and gasoline from the equation. So people are still spending. And I think this is kind of the key thing to really continue to watch is the true sentiment indicator for the consumer is not what they're saying on these surveys, but what they're doing with their wallets. And everything points to retail sales are up. And that's why GDP, I think we're going to get some GDP estimates also on Thursday. GDP is also expected to be going up. So across the board, everything still looks pretty solid, and that's being reiterated by our bond indicators. And we'll talk about it in the technicals here going forward. Yeah.
Here's all the data coming out. The PCE is the big one, then the first quarter final GDP report, but that we know already. It's going to be revised a little bit. But the big one is PCE, which is the personal consumption expenditures index. It's a mouthful, but that's what the Fed looks at as inflation. Everybody pays attention to CPI and PPI, which is consumer inflation, but what the Fed looks at is that particular index. Looking at the technicals, markets were down today. Looks like we made a third wave top. We've got a fourth wave pullback here, and we are right at the 20-day moving average, which is 74.49. Today's low was 74.61. We closed very close to the lows of the day, so we'll see if this holds. If not, we probably will go test the 50-day moving average on this fourth wave. Fourth waves are usually not quite straight down, straight up, but they are messy. They go back and forth for a while. And that's why I think we're going to do this. But there's still a chance that we're going to break out above the third wave and go for the fifth wave top.
So we're kind of recharging to maybe break it out to the upside.
Until we break out. So, but it could take some time. See, a solution of the Straits of Hormuz, the Iranian situation.
There's 60 days.
Yeah, so it could take a while for that to. Same thing here. Looks like we're making a fifth wave top on the weeklies, but it takes a while. These are weekly charts. They don't top out in 1 week, and tops are usually not V tops. They go up and stay there for a while. Here's the daily NASDAQ, third wave top, fourth wave pullback.
Overall, just looking at these charts, they seem pretty messy.
Well, this is the
kinda
fourth
like,
wave
just,
going back and forth.
Yeah.
And fourth waves are like this before they break out to the upside. But still, my strength indicator is saying that there's a high probability that it's going to break out above this 27,200. Weeklies, same thing as the S&P. Looks like a fifth wave top, but
we're just in that extended phase.
Extended phase. That's where we are, and we could stay there for weeks and weeks and weeks. Small cap, third wave top on the weeklies. This is not a daily chart. This is a weekly chart. So small cap could see the fourth wave pullback before we head higher. That's the way it's looking right now. Same thing with international. Third wave, fourth wave pullback will come somewhere, and that's down here. Once we complete that, then we're going to go for the fifth wave.
So it seems like kind of previous to where we were, we've been kind of chopping around, but because we went above those previous targets, we're now still in we're in the third wave.
And it could chop around. We could be going to fourth wave, where we see it chop around for a period of time before we start a fifth wave. Oil, now this is a different story.
Yep.
You talked about this 19 area.
Right at 19 was my number. That was kind of the lows we kind of hit back in early April when it first started. You know, you had the big escalation in March, and then it came down in April, and then so that was kind of my new channel. And so we finally broke below that today.
Today we're at 18.52, and it was down. It looks like we made a fifth wave top, wave 1, wave 2, we're in wave 3. We could see a bounce somewhere. It looks like we're headed towards 15.
That would be great. Yeah, if we can get back down to 15, then everything is looking good in terms of oil. But I think it's gonna, I don't know, it seems like it's gonna be hard for them to, unless, in my opinion, unless the U.S. really gives them everything they want, which it seems like we've kind of have done, then, you know, who knows where this thing continues to go here long term. But
I think as long as the straits remain open, we're at $70 to $80 a barrel. We don't go down into the 60s.
No.
I think, but we 70 to 80, and that's where we could stay.
I would actually be concerned if we went down into the 60s. And then this is one thing I was talking about with clients last week. You know, oil prices going down is great if they're going down for the right reason. If we're getting through a geopolitical event, right? And it seems like now the market, we talked about in previous podcasts and YouTubes, is this a geopolitical event or is this a supply shock? And it seems like it's more in the geopolitical event, you know, and the market kind of has read that the whole time. But I think one of the key things is we don't want oil prices to go down because growth is slowing down, right? And the way we're able to monitor that is through high yield. And so far, you know, oil prices, it's just less inflationary pressure, but we're still seeing the growth. So it's all good.
Yeah, you don't want oil prices going down because there isn't enough growth.
Demand.
That people have just stopped building stuff and industry's slowed down and everything is slowed down. So demand for oil goes down during a recession.
Correct.
We don't want oil going down because of a recession. We want oil going down because we've got the supply coming back to market. That's really the way I look at it. But if it goes down too much, that means global growth is slowing, which is not good for profits, not good to make money. Companies don't make as much money during that time. Same thing with the weekly chart. Looks like we made a top here. We've come back down. You know, we could stay right around here, which is the area we're at now, somewhere around 18, 19. And I think we're going to stay there for a period of time. Interest rates also spiked up. They got up to 4.7 right around here. We backed off. Now we're at 4.5 today. Right at the 50. I think this is the island top that we talked about, but we came and filled these gaps back up to 4 point. I just think that somewhere here between 4.25 and 4.5, if we can stay somewhere in that range and stay here, I think we're okay.
And actually, I really like that range because once again, it's kind of, you can bake in a little 2% inflation and you get 2% GDP growth. that's your 10-year treasury rate is your real it's your inflation plus your growth is kind of an easy way to look at it. And so if we have 4.5, 4.4, 2% GDP growth, 2% inflation, that's a good place. We can continue to mosey along.
Here's the ETF, the gold ETF. Gold seems like, I thought we made a top that 5,000 level for gold.
I remember we were telling people, put some collars on it if you could.
It's. I think gold is just in a downward trend now. That's really what it is. Where does it bottom out at? Nobody knows, but I think it's just headed lower.
Well, and I think if Kevin Warsh is going to be Chairman Warsh is going to be very kind of not hawkish, but very, they kind of put in things that are really going to try to bring down those inflation expectations. That's going to bring down interest rates or keep interest rates somewhat elevated, right, to curtail inflation,
right,
and that's going to be a negative impact on gold.
This is high yield, and when it breaks below this green line, that's not good, and that was an indication right here.
This is back February, March.
It was indicating something is wrong. Broke out above it, beginning of April, and now the high yield is still doing better than government bonds. The green line is government bonds, and the red line is high yield bonds. And as long as high yield bonds are staying above, that's good.
Yeah.
And the relative strength is sort of going sideways. No, not really breaking out, not really breaking down.
And this is why we said throughout the entire crisis, it wasn't great. Things were jumping around, and it was tough to, I think, buy those dips, right? But I think the most important thing was to maintain, right? Don't sell and get concerned, don't panic. And the bond market really kind of fretted that out. And actually, this high yield relative strength chart bottomed out on March 1st. March 1st, right? Way at the beginning of the entire situation, and has been since just recovering the entire time since then. So I think this indicator, we're going to ride it for a while, continues to continue to work, and it's definitely giving us still a very much everything is okay signal here going forward, which is great.
Those are our thoughts. That's the way we're looking at the markets this week. We will be back with you next week. Again, don't forget to subscribe, like and subscribe, and you go to the YouTube channel. Go to compact.com, click on Insights. All the YouTubes are there. You can watch everything. If you need help with your portfolio, go to invest@compact.com or just give us a call at 800-388-9700. Those are our thoughts. That's the way we're looking at the markets. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.